so that I can still show people that it's possible to invest in these while you have a day job, and that these opportunities are for people primarily who cannot or who don't have the time to take on a second full-time job as an investor.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying the show and get some great value, let us hear about it and leave us a rating and review. It helps us, and it also helps other listeners and investors find the show for their investing goals. And listen, if you haven't done so, make sure you hit that follow or subscribe button so you don't miss an episode. We've got a great show today. We're going to be talking to Keshav, Kolur. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to KasmanCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to KasmanCapital.com and click on the Mastermind button today. Keshav Kolur is a full-time real estate investor and the principal and founder of Clive Capital, a private equity firm based in New York City. Now, since finding Clive Capital, Keshav has helped investors allocate capital to 4 properties with a combined asset value of more than $40 million. And that has a projection to grow to $178 million over the next 5 years. Let's welcome to the show, Keshav Kolur.
Yeah, thanks so much for having me on, John. It's an honor. Like we were talking about before the show started, I one of the first books I read in the industry was the Best Ever Apartment Syndication book. I remember going through the reviews and seeing your name on there. So it's an honor to be on here.
Yeah, absolutely. It's a great book. Absolutely phenomenal resource written by my friend and mentor, Mr. Joe Fairless, which I highly recommend everyone to check that out. Keshav, I'm excited to learn more about you and your story. Why don't you take 2 minutes and fill in some of the gaps from your bio?
Yeah, sure thing. I guess we should go back and update that bio. I think we're at 7 properties, maybe 8 now. So over, I guess, kind of the journey, I graduated college 5 years ago with a mechanical engineering degree. Went into the automotive industry as a software engineer in Detroit. And at the time, I also read Rich Dad Poor Dad, actually, on my graduation trip. Went to Southeast Asia, a 15-hour flight one way. So it was a good time to read that book. It didn't take all 15 hours, but it really got me thinking about real estate and how I want to build wealth for myself. And that got me down the path of being a realtor, actually, and going out and buying single family homes. I don't know if I should have gleaned the concept of syndication from that book. Maybe I should have, but uh, as I was becoming a realtor, my friend introduced me to syndications because his dad was investing in them. And so that sounded a lot cooler to me, buying apartment buildings rather than just buying one home at a time. And I actually found out about it through a Reddit post. That friend, he sent me a Reddit post where someone was talking about syndications, and he said, "Hey, my dad does this too. This might be something you're interested in." And that was September of 2020. I reached out to the author of that Reddit post just to learn more. And over the next year, really branched out into the syndication network, talked to a lot of operators and folks who were more experienced than I was, and made my first jump as an LP into 108 apartment syndication in September 2021. Once I started seeing the cash flow come in and the tax benefits as well, the K1 form, I figured I'm going to do this for my family and friends too, not just myself and anyone else who's interested along for the ride. So I started my company in 2022, Clive Capital, and we help tech employees primarily and other high income earners build a private equity investment portfolio passively so that they can achieve generational wealth and passive income. So far, we've helped people invest into over 1,000 apartments under renovation, the value add strategy, and over 500 single family rental homes under development. And we're about to expand into industrial real estate, private lending, oil and gas as well. Really, the 5 things that I try to balance when I'm building a portfolio for myself and for my investors is appreciation, cash flow, tax benefits, liquidity, and risk. And each investor is going to have their own personalized blend of what they want their portfolio to look like. So I try to bring a varied, buffet of investments to my investors so that they can build a portfolio that, that best suits them. And I'm really there to help educate them, guide them through the process so that one day they have, 10, 20 investments paying them every month, every quarter, whether they're working, sleeping, traveling with family, whatever it is.
I love it, Keshav. You talked about, your background and graduating with your degree, working in the automotive space out in Detroit, which we share that in common. I spent some time out in Detroit working in the automotive industry as well. But from there, you really started to wrap your head more around syndications based off that Reddit post from your friend. And that got you going down that pathway, reading Rich Dad, Poor Dad, eventually learning about syndications, and not just investing yourself as an LP, but also starting to bring in the people closest to you, your friends and family, so that they can enjoy some of the benefits that passive investing has to offer. Talk to me about kind of that transition. I mean, when you were reading Rich Dad, Poor Dad, were you still in your automotive job? Had you already moved to New York? What was it that kind of got you to say, you know what? I need to find a way to create passive income as opposed to just doubling down on this day job.
Yeah, so I'm actually still at a day job. I just work both like full-time jobs, which that takes a lot. But so from Detroit, I worked as a software engineer in 2020 when I learned about syndications, and I learned originally my goal was to start a robotics company, and coming out of college, but then I realized, hey, a lot of these guys go back to school for masters and PhDs, and I just didn't want to go back to school. And so I figured, hey, there had to be another way to make an impact for myself and for those around me, improve the quality of life. And so I found, investing to be that route. But I realized also that, hey, to invest, you need capital to start a business, right? To start a fund management company, which is really what Clive Capital is. You need capital. So I knew, and I wasn't experienced enough yet to quit completely. And so I figured, hey, I'm going to build them both up side by side so that I can, still show people that it's possible to invest in these while you have a day job and that these opportunities are for people primarily who cannot or who don't have the time to take on a second full-time job as an investor. So I switched jobs from the automotive industry into Amazon and actually moved to New York in September of 2021. Well, I switched to Amazon in March of 2021, worked remotely for 6 months. Then Facebook snatched me away in September of 2021. And so I started at Facebook and also moved to New York about almost 3 years ago now. And so I've been working at Meta since, and then also been building the fund management company on the side as well.
I love it, man. You talk about tapping into that corporate background, right? And just growing that, building your passive income on the side, but also bringing those other people in where they can get some of those benefits. And you're right. I think a mistake so many people make is just running out and trying to do it without really taking the time to learn the business, to grow the business, to build the business so that you have something successful if you ever decide that you want to go full time in just one lane as opposed to trying to build the business while you work that day job. And that's what we had to do as well, right? We had our day job, worked that for a number of years, slowly started building up the portfolio. As you got more traction there, I got to the point where I can make that transition into being, just a full-time real estate investor. Let's talk about some of the things you've learned along the way in your process, right? So, starting out, you began as an LP investor. How many deals did you do as an LP before you started to kind of transition to being a general partner?
I did one deal actually
One
as
deal.
before I jumped in, but I took a year to do that first deal as an LP. Coming from an engineering background, we're taught to be very risk averse because if we're building cars or we're building bridges, whatever it is, well, you don't want that to break, right? So you double check, triple check, and you're very apprehensive about getting into anything new or, working with someone new. So I worked through that fear personally for about a year. And when I felt really comfortable, then I made my first investment. But I made sure that I would make that alone and wouldn't try to bring family and friends on. Once I started getting comfortable with that and built a good network, knew who I was going to work with, then on the next deal, I started raising capital and I also put my own capital in as well. So whenever I am able to, I put my own capital into my deals alongside my investors to show alignment of interest. And I also show them all the homework that I've done on the sponsor and really walk myself through what my very first investment was like for me. I invested in my first syndication when I was 23. I'm 26 now. So I remember what that it's a solid chunk of change for a 23-year-old to wire someone that I had never met in person before because that was during the COVID era. So, I took that year and then I made my own investment. And once I did that, I built enough confidence to where I could bring my passive investors on to deals that I was co-GPing on, being a fund manager on.
I love it. Hey, talk to me more about that, right? Because I think the due diligence process and learning about operators, that's a challenge for some new investors. So, as an LP or a passive investors, talk to us about the process you use to conduct that expert level due diligence process.
Yeah, definitely. So one thing that people will tell me that, and actually just came off of I was at a Avestor conference last week, and I was on a due diligence panel for there as well, where I was able to speak to some of this. Anyone who works with me will tell you that I'm a pain in the butt because I ask so many questions. And I think, especially if it's your first time investing as a passive investor, that's what you have to do because it's a new world to you, and it's not a world without risks. A better way to word it is a world with some risks. If you work with the wrong people, then you will get burned, right? This world of private equity investing, alternative investing is great. You have to make sure you work with the right people though. So I put together just from all the books that I've read, the videos I've watched, people I've talked to, I've actually put together a list of about 100 questions that you can ask anyone that you work with, regardless of asset class, whether it's multifamily, industrial real estate, startups, whatever it is. This list that we put together, it's on my website, clivecap.com/alternative dash assets. And it goes into the things you should be talking about, asking about, including the sponsor and their background, what the business plan is, how they view debt, right? How they mitigate risk, things like that. And some concrete questions. And then also just testimonials are huge. And just some of their marketing materials, their social media presence, any sort of thought leadership platform, right? Some of the questions, not to be super vague, some of the questions include like, what was your background before you did this, right? What did you leave to do this full time? What's your experience been like? What are some of the worst deals that you've done? Why did they go bad? What have you learned from them? And then also, when you're talking to testimonials, right, talk to lenders that they work with, insurance companies, brokers, and investors that they work with. Ask for their past deals, right? Like get a sample PPM from them, get a sample offering memorandum from them, sample underwriting, sample investor reports, things like that. And really try to simulate for yourself what it would be like, what your experience is going to be like if you choose to invest with this sponsor.
No, I like that. You talked about having a list of 100 questions on your website, and we'll link to that in the show notes there. But asking questions, checking out the testimonials, checking out the referrals. When you talk about the questions, what's that process like? 'Cause I know some operators would really cringe up if they start getting a list of 100 questions asked to them directly. So, what does that process look like in real time when someone's talking to an operator having this conversation?
Yeah, I think any operator who is worth, their weight in gold should be willing to hop on this call with you, especially if it's your first time investing in syndications. If you're a pro at this and maybe you heard about this sponsored through a referral process or something, where another sponsor refers you, then maybe 100 questions is overkill. Like now, every new sponsor I vet, I don't ask 100 questions necessarily. I usually have heard about them through the industry for the last few years. I know and I've kept up with their work where I feel comfortable enough investing with them. But for someone's, and maybe I only ask like 50 questions instead. If it's a sponsor that I have seen and work with and it's an asset class that I understand. If it's an asset class that I don't understand or a sponsor that I haven't worked with, then I go back to those 100 questions. But to someone who's just starting out, if an operator or a sponsor, if you as a passive investor are talking to someone, then you should make that clear. This is my first time investing in outside the stock market. I think that one, that will kind of set the environment and the tone for the conversation so that whoever you're talking to on the other side, whether it's me or you or someone else in the industry like us, they know what to expect. And I think then it's a lot easier to go through those 100 questions. And you should just say like, and I mean, people should know this too in our industry, and it's sad that I have to say this, but people are investing their life earnings with you. They work 40, 50, 60 hours a week to put bread on the table. And with costs rising every day, it's harder and harder to save. So this is the money that they've managed to save. And if they're parking it with you, rather than parking it somewhere else where they have thousands of other options, I think as an operator or sponsor, we should be honored that they're considering us and really take the time to walk them through what it's like investing with us.
As you go through that process, I mean, obviously 100 questions can be a lot of questions to go through. What are you looking for? Are there's some questions that carry more weight than others? Are some of them, I presume many of these questions are questions that would be answered in any offering, right? When you talk about the business plan and certain things like there's certain information that's on the website, that, you're going to get before you maybe hop on those calls. So I'm not, I'm assuming that you're not literally sitting there asking 100 questions in a row and doing
Yeah.
that. But what are you paying attention to? Like, what are your red flags? What are the answers you're seeking? What are the things that would give you a lot of concern?
I think if someone hasn't gone through a bad deal before, that concerns me a lot because that just means they're really green in this field, right? And even though I've been in this field for 3 years only, like we've gone through some rough waters. And so, anyone who started in the last 3 years, like they should have some pain points, and in the last 3 to 5 years, they should have some pain points as far as the new just wave of supply that's coming online and how that's affecting vacancy and rent collections. If they took on floating rate debt, there's definitely a lot of pain there. If you're investing in the Southeast, one of our projects that we're doing are built rent developments along coastal Louisiana and Alabama. Our rents have doubled on a per door basis in the last few years. So if they haven't had something gotten bought bad on them, that's something I watch out for. If they don't have a significant track record, or they don't have someone on the team who has a significant track record, that's something I'm always wary of. If it's their first time doing something new, if they primarily did multifamily and now they're going into office without the right experience, also that is something that worries me, right? It's like I'm asking, I don't know, someone who's train like operator to go a conductor then like hop on a flight with me and like fly me to wherever I want to go, right? Like stick to your lane, know what you're doing, or have that co-pilot who knows what they're doing. Besides that, with again, also going back to when things go bad, one, why did it go bad? And then two, how did they handle it when it went bad? And I would say how they handled it matters more if they didn't communicate with investors very promptly, if they didn't learn from that experience, if they tried to chalk it up to macro events rather than completely chalking it up 100% to macro events, rather than taking some lessons for themselves for the future, it's things like that that worry me.
Keshav, I love what you just said there, right? Because I think ultimately, when I look at the 100 questions, what I'm always trying to get to the same conclusion, which is this the right partner? Is this the right operator to work with, right?
Yeah.
And everyone has different approaches. The more seasoned you are, the quicker it is for you to be able to ask more poignant questions to identify that. But what you're getting at here in summary is one, understanding where they've had challenges. Have they had a deal that went sour? Have they had challenges in the business? And then how did they overcome those? How do they talk about it? Do they point blame at, others? Do they blame the economy and macroeconomics, or do they learn and take ownership and accountability for the things that they can't control? ultimately, we're not expecting everybody to be perfect, but we are expecting to work with people who can learn and grow and also have a significant amount of experience, a significant amount of experience to mitigate those risks in the first place altogether, but knowing that you will encounter some challenges along the way. And when those challenges appear, understanding that they have the ability and the aptitude to navigate those things to the best of their ability. And I think that's great, right? You talked about the experience. I wrote down not just experience and track record, but experience and track record doing what it is they're looking to do. So if you are primarily a B class multifamily value add investor, that's what I want to see, right? If you come to me with, now you've got this, brand new development self storage, well, you don't have experience in that space. It's not to mean that you can't do it and can't succeed, but that's a new thing, a new challenge, new barriers that we're going to have to overcome, right? So I can rely on my experience with you in what you've done, and we can certainly forecast that, yeah, you may be able to figure this out. But I would also want to see somebody with that experience on the team that's done new construction, self-storage, right? To complement what you're doing. And that's really important. The last point you made was how do they handle it? I think that is the most important thing. You want to deal with people with high character. Sometimes when you look at track record, it's very easy to get impressed because almost every operator has success from 2018 to 2021, 22. Everyone did well, right?
Yeah.
And there are very few operators who struggled during that time period. So simply looking at the deals that were successful is not enough. It helps that you're going to learn a lot more if you understand the challenges that they faced, but also how they handled those challenges. So I think those are very great questions to ask. To give a little spin on what you said, a question I always like to ask is tell me about a deal that didn't go according to plan. And sometimes deals don't fail, but every deal, has some challenges and things that come up. And it's not to hear that they lost money or there was a big issue. It's to get at what you were just saying. How do they handle this? Are they going to start blaming their contractor? Or are they blaming the bad property management company? Are they blaming interest rates? It's not to say that these factors aren't legit, but as an operator, you want someone who's going to take accountability to say, hey, here's how we changed. Here's what we do. Now we don't do deals like this. Or, hey, now we only do this. Or we've added this to our due diligence process. Those are the things you're looking for to make sure you're investing with a company that is actually suited to grow and protect you and your capital. I love what you said there. Thanks for sharing that. As we're chatting, we're kind of jumping ahead and getting into the fact that there's certainly opportunities in commercial real estate and multifamily. I know that you've expanded to oil and gas and some other sectors. Someone's listening to my like, I have all my money in the stock market. Why should I even bother investing in real estate in the first place? What is your thoughts on that?
Yeah, it's a great question. So I would say there's a handful, maybe like, I don't know, 5 to 10 reasons primarily that I invest. One is to start off superior risk-adjusted returns, right? I don't want to chase higher returns if that means I'm taking on significantly outsized amount of risk. If that were the case, I would just go into crypto or gambling. So that's one. For the risk that you're taking, the returns tend to be higher. I'm not making promises. These are just projections and past experience. That's one. The stock market does 10% on average every year, I believe, if you reinvest your earnings. And that just isn't enough for me. If there's a better alternative out there where there's other advantages that I'll get to here in a second, then I'd rather explore that route, right? So superior risk-adjusted returns is one. Two is tax benefits, right? High earners, especially, I'm from the tech world, work at Meta now. A lot of people, their biggest expense or their biggest obstacle to growing their wealth is taxes. So on their income, but also on their investments. So if we can find a way to reduce our taxable income passively and legally, then we should go after that, right? So that's one. There's more tax benefits in the world of private equity syndications, alternative investments than there are in the stock market. Third is diversification. I really don't like the stock market. I plan on getting out of it as much as I can, but that doesn't mean that has to be everyone's philosophy. But for me, I don't want all of my eggs in one basket, right? If a war starts or, another country falls into some sort of economic recession because they're mismanaging their debt, that affects our economy here just because of quote unquote fear and uncertainty in the market. And I don't like that something that's happening halfway across the world can affect 100% of my portfolio, right? On the other hand, if a war starts somewhere, that's really not going to affect our building values here, our property values here, for example. So I don't want my entire portfolio to be correlated with each other. So that's why, real estate, there might be times when real estate is up and down, and there might be times where the stock market is down and up in inverse. So balancing that out has been big for me. And let's see, I would say volatility is another big thing. I don't like waking up and seeing my investments down 20%. And I work at Meta. Our stock went from 300 bucks when I joined in September of 2021 down to 80 bucks at its absolute low. That's down, quick math, 75%, right? And it's back up now. We're doing well. It's at 580, but I don't like that roller coaster as much. I personally prefer stability. And especially when you're, around retirement age, if you imagine all of your nest egg in the stock market and you only have to rely on that, and then for a few years that nest egg drops by 20, 30% in value, that wouldn't sit well with me, at least, knowing that's my only source of income. Also, cash flow is a lot better in private equity syndications. In the stock market, you mostly bank on appreciation, right? You mostly bank on, hey, the next guy or gal is going to pay more for this stock than I am, and I'm waiting for this stock to grow. People will say that they're up 30% on their Nvidia investment, but you're not up anything until that money actually hits your account. And I think that's what a lot of people don't realize when they talk about their stock market gains. It doesn't matter until it's in your bank account. Right. And that's where cash flow is really important. In the stock market, dividends, you'll get what, 4% a year, something like that. But in real estate, other private equity opportunities, you'll do a lot better than that. Anywhere between 5 to even 20% a year in cash flow, depending on what you're investing in, right? And where you are in the business plan. I would say I could go on forever about this, but I would say the last big thing for me is transparency in two ways. In the private equity world, you're on a more level playing field where, in real estate, for example, we're all competing with each other with the same amount of resources to go after these apartment buildings, for example. When I'm in the stock market, God forbid if I try to day trade and beat that 10%, I'm competing against Citadel and hedge funds who have algorithms and inside information that I could never dream of getting my hands on. There's no such thing in the private equity world, right? Things move a lot slower, and because of that, as long as you're patient and slow, it's more of a level playing field. Not completely, networking connections still help. And then lastly, I would say private equity, it's these, again, syndications, multifamily, that what we do, it's a lot easier to understand the business plan. You can say, here's my revenue, here are my expenses, here's my cash flow. And based on the cash flow, here's how much I get to value this asset at. I couldn't tell you how Facebook gets its valuation of, hundreds of billions of dollars. There's, there are multiples involved. But it's a lot more of an opaque business plan to understand than something as simple as real estate, or oil and gas or private lending, for example.
Yeah, I love the points there because it really comes down to influence, right? In the private equity world, when it comes to real estate investing, you have more influence over the investment, right? You can pick and choose the asset class. You can understand the story. You can dig in and understand what's the plans for this neighborhood or what's going on in this area. What are the comps? But you can see more of the actual business plan. It's more tangible there. You can understand what the investment is, what most people are likely going to pay it or buy. I should say, pay for it. But when you get into the stock world, like you said, I mean, one day the same business is valued at $80 a share. And one day it's $300 a share. And the day after that, it's $580 a share. And a lot of times it's just because people are excited they're more excited today than they were yesterday, right? Or there was a war that happened, or there's whatever else that was a temporary impact, and has nothing to do with the fundamental business. And that always
No.
threw me off too. I just couldn't really wrap my head around that, but I love the tangible nature of real estate and the influence that I could place on it, right? I could go in and renovate some of the units, I can upgrade the kitchens, I can make it a better living environment. And for that, I could increase the rents. And that just was simpler to me. And I like the fact that we have more control. It's more tangible. People understand exactly why this property is worth more now than it was last year. And it's not just speculative. It's because it's making more money. It's in a better demand area, or the area has improved. And that's something that people can bank on. Love the points that you made there. You have mentioned that you're expanding into oil and gas and some other industrial and things like that. You're launching a fund to help investors. Why a fund, and why should people look to invest with you?
Yeah, so I think, all multifamily is a great place to start. It's the bread and butter for, I would say, most people who get it, a lot of people at least, real estate investors who come from that world. But I haven't been in the business long enough to be able to back this up. But I've been told that, before I would say 2015, 2018, returns used to be a lot higher, right? Like 20% IRR on some of these investments. Correct me if I'm wrong, John, but
They
did
did.
you
Well,
think
I
that?
mean, competition has come in. You mean the challenge? I mean, the beauty of this, right? If you find something that's incredible and you're getting these great returns, and you start telling all these people about it, well, just like supply and demand, right? There's more demand now for this. So to get that 20% IRR on a B class property, it's just not as realistic. So that does start to compress a little bit, and people are fine with now 16 or 14 or 15 or whatever the case may be.
Exactly. And so, again, I haven't lived through that, but I know that and it makes sense, right? Early on, the early bird gets the worm, but then eventually everyone finds out about the worm. So for me, multifamily is great, and it's always going to be the bread and butter of the investments that I make and that our investors make. But I always, as a fund manager, one, like I said with diversification, don't want all of my eggs in one basket. And there's a couple of different ways to diversify. You can diversify based on the geographic market you're investing in, right? Like Atlanta, Austin, Tampa, Phoenix, etc. You can diversify based on the operator that you're investing with, right? Investing with different teams in these different locations. You can invest with different business plans, right? Some could be a core business plan where it's buy and hold. Some could be value add. Some could be distressed. And then I would say the fourth axis on which you could diversify is asset class. So multifamily is great, built to rent is great, but I also like, again, industrial real estate, I would say is even safer than multifamily. The returns are a bit lower, but if that's what I get for additional stability, then I'll take that all day long. Um, and and then remember the five things that I mentioned earlier is appreciation, cash flow, tax benefits, liquidity, and risk. So multifamily is generally going to have the same amount of all of these five, right? But if you get into oil and gas, for example, your cash flow is going to be a lot higher. There really isn't the concept of appreciation. It's just drill and sell, drill and sell. The tax benefits are great because the depreciation you get there, I'm not a CPA or tax professional, but the tax benefits you get there, the depreciation you can use to directly reduce your W-2 income, for example, which I know with real estate, a lot of people that are in my camp in the tech world, that's a big pain point for them. Depreciation in real estate is great. That means your cash flow goes tax deferred that you pay. But that doesn't really solve the main problem of our W-2 income being taxed. And so oil and gas solves that. Then another thing, for example, is that I don't want my money locked up for 5 years. Maybe I only want it locked up for a year or 2 years or even 90 days. And so there are a lot of, debt opportunities, lending opportunities out there that give you anywhere between like 10 to 20% while giving you that liquidity option to get your money out quickly. And and then, for example, we like development because there's no cash flow, but there's a lot of appreciation and forced value that we can add. So I think that's big for me is just it's like a buffet. I like a little bit of everything, and I have my favorites. But I like to diversify and try to have investments that tackle those five criteria that I mentioned. So that's why we're expanding outside of multifamily.
Well, it definitely gives our listeners something to think about. Wrap your head around what you are looking to achieve. You talked about the different strategies, oil and gas, helping with some of the tax benefits there, especially if you're a W-2 employee. New development, obviously, being more of an appreciation play, multifamily, kind of that anchor, delivering on a combination of appreciation, cash flow, tax benefits, and diversification. So lots of opportunities there. If you want to learn more, you can go to clivecap.com. That's CLIVECAP.com. And we will also link to the 100 questions that you have on your website as well. Right now, we're going to transition and go to our round of insights. All right, Keshav, give me a failure or an apparent failure that sets you up for later success.
Yeah. Oh man, so many. I would say, on I mean, there's a few, I guess, but let me think here. I would say with my very first investment that I made, that investment as an LP, that was on floating rate debt at the time, like 80% leverage. And distributions have been paused for a year and a half now. So, I mean, that's a big lesson learned where if you are going to floating rate debt, just know what the consequences are, but be very apprehensive about it. Another big thing that I've learned on our build to rent developments, where I'm an operator as well, like I'm a partner, mainly focused on underwriting and raising capital, kind of structuring the deal. Acquisitions, basically, finding the capital, finding the deal, and handing it off to our team to execute on. It's just always keeping a pulse on the market. And I think this applies more broadly to any asset class that you're in. But again, when we started the deal, insurance was about $1,000 a door, and right now it's about $2,000 a door, right? So always keep your pulse on the market, whether you're investing in multifamily, again, any of the other asset classes I mentioned, even startups, right? Always stay up to date, keep your pulse on the market, and know that your projections don't mean anything. They're just projections. You're either gonna, hopefully you hit higher, but like there are chances you could hit lower too. Rarely is it ever on the bullseye. So always monitor where your investments are, like keeping it with the market news, what's going on in that, like on a macroeconomic level within that industry, and then like on a sub-market level too, right? Like what's happening in the northwest pocket of Atlanta, for example. So stay educated, stay fresh.
Love it. Give me a digital or mobile resource you recommend for your business.
Okay. I would say it's that, well, in addition to the due diligence checklist that I mentioned, we have a YouTube channel as well. If you just Google or go to YouTube and search up Clive Capital, we host webinars, try to provide value, just like you're providing value here and have been. And we bring on guests from all types of facets. I'm trying to gear the podcast towards just passive investors, right? Like not only what kind of investments you should be making, but and how you should be growing your wealth, but also how do you protect it, right? Like what kind of tax strategies can you use? How do we maybe structure the life insurance policies? Because I'm building a life insurance policy right now. You know, once your wealth is really working for you, how do you look at protecting it and passing it on through trusts and estates, things like that. So definitely go check out my YouTube channel as well. We'd love to see you all there.
All right, you mentioned Rich Dad Poor Dad earlier. You also mentioned the best ever apartment syndication book. But give me the book you've recommended or gifted the most in the last year.
I would say The Hands-Off Investor has been another one by Brian Burke of Bigger Pockets. That's where I've gotten a lot of help from the due diligence perspective. Like, hey, because that book walks you through the A to Z of this is your first syndication. How do you analyze it? What questions should you be asking? So, I haven't had the bandwidth yet, or maybe even the experience to write a book, one day, but this is definitely a book that I would recommend for people getting started.
Give me a daily habit that helps you stay focused on your goals.
I would say planning the next day. So, maybe 30 minutes before I go to sleep, always look at what I did today, what went well, what didn't, how can I improve? and then just looking to the next day, and also maybe on like a either I think like a 30-minute time increment, just planning out what I'm going to do, and trying to be reasonable about it. Like, hey, if I can get this much done, that's like a stretch goal, but I have to get at least these most three important things done.
Give me your number one insight for being a successful passive investor.
I would say there, really doing my due diligence on who I'm investing with and what I'm investing into, really understanding it. There's always a lot of hype about a lot of different things, right? We saw even during my investing career, just crypto take off a lot and NFTs take off a bunch. In the syndication world, we saw, everyone going into leverage debt, 80%, highly leveraged floating rate debt, 80%, and investing with operators who, a few weeks ago were just dentists or firemen or software engineers, what have you. So there's, I think, controlling the hype, like when these investments take off or when you first learn about an investment. I've been guilty of this too. I've been trying to find a oil and gas syndication to invest in for about 2 years now, like since February 2022, um, because about the takes great tax benefits primarily. But then I learned about how like prevalent just scams are in that industry because oil and gas is even less well understood than real estate. So luckily, I've heard of horror stories where the groups I was looking at investing with have are scams. They haven't been caught yet, but they will be outed one day or another. And so I'm glad I waited to work with a company that was reputable, with someone in my network that I could trust who had more experience than I did in this new asset class. So, figure out who you can trust, do your due diligence to trust those people, and then build your network from that kind of anchor point, right? I met that person on Reddit, branched out from them once I verified that they were a good person, very moral and ethical. Branched out from them, took recommendations from them about other people I should talk with, and then just kept networking out and out, primarily using referrals.
Love it. All right, let's lighten the mood. You are in New York City, Lower East Side area. Give me your favorite place to grab a bite to eat.
Favorite place to grab a bite to eat? Oh man, there's so many. There's a pho place that I go to near me. I just can't think of the name off the top of my head right now. It's on First Avenue, maybe 8th Street. So it's just down the road. It's one of my favorite places to go.
All
Yeah.
right. All right. You think of the name, we'll put in the show notes. You all can check it out there. Keshav, great information, man. Really enjoyed hearing about your story coming from more of the tech background, working in software design, software engineer in Detroit, making that transition into the space, but getting in as an LP first, really off of a Reddit post, taking that Reddit post, reading more about it, this reading the Rich Dad Poor Dad book, reading the Best Ever Apartment Syndication book, and realizing that you wanted to invest as an LP first, then slowly started bringing on friends and family members. Now you've got your company, Clive Capital, working with other investors and helping them to invest passively across not just multifamily, but other industries and asset classes as well. And thanks for sharing the due diligence tips, right? So having those 100 questions that you can refer to, asking the right questions, but ultimately trying to determine whether or not this person has the experience and track record in that specific space and with that specific business plan to deliver success. I think that's the key element of making sure you're doing your due diligence the right way. Again, for folks who want to learn more, they can go to clivecap.com, and then we'll also put a link in our show notes to the 100 questions that you have on your website. Keshav, thanks again for coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.